Hello and welcome to this weekly market recap video. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com. The following video, I'm just going to take a look at the week ending, the holiday shortened week ending November 29th, 2024. It's kind of a mixed week in terms of economic reports. We had a really strong pending home sales report, but a very weak new home sales report. We had initial jobless claims, which came in better than expected, but we had a Chicago PMI that was a little bit worse than expected. Personal income came in better than expected. Personal spending was flat. It wasn't flat. It was actually up, but it was as expected. So all in all, I think it was just kind of a so-so week in terms of economic news. But we did see the 10-year Treasury yield pull back down a little bit as folks went back into bonds. So I thought that was a positive and something that we were looking for. We wanted to see that TNX 10-year Treasury yield get back down into that 410 to 420 area. And that's where we went last week. So that was kind of what we were expecting. And I think as money was pouring in a little bit to bonds, I think it was giving a little confidence to the stock market that the economy's still fine. Inflation really not a problem. We had a couple of reports out. The PCE came in a little bit better than expected as part of the GDP report. GDP came in exactly as expected, but we did see that annual rate of the PCE drop. I think we were looking for 3.7%, came in 3.5%. So all in all, I thought the news was fine, wasn't great, wasn't horrible. And the market did what it normally does from about November 22nd to the first week or so of December. It went up. This is one of the strongest periods. I talked about this last week. This is one of the strongest periods of the year historically. Doesn't guarantee us that the market's going up. It just gives us a sense of the historical trend, which has been higher, and that's exactly what we saw last week. So anyhow, let's go ahead and take a look at what happened last week. And I'm going to start off by looking at just the overall action from Friday, and then we'll take a look at the weekly action. But on Friday, we saw the Dow Jones jump 188 points. We finished almost 45,000. That's a psychological level. The Dow's never finished over 45,000 before. We finished at 44,910. So getting pretty close, down only about maybe 0.2% away from that $45,000 or 45,000 level. S&P 500, we had struggled and struggled and struggled at 6,000. We're up 34 points on Friday. We actually finished up above 6,000, 6,032. So nice to see a few closes right around 6,000 and finally get one significantly above. The NASDAQ, you can see NASDAQ jumping more than the Dow and the S&P, rising 0.83%. If you look down at the NASDAQ 100, we actually got a rise of 0.9%. So that was the best performing index on Friday. It was a holiday shortened 3.5-hour session. Is that right? Yeah, 9:30 to 1 o'clock. So really didn't have a whole lot going on. Normally volume is light. It was light again on Friday. Volatility index, though, look at what happened from the middle of the day on Wednesday to the close on Friday. We actually were above 15 on the VIX, and we ended up closing down at 1351. So that was about a 10% drop in the VIX in just 24 hours. From midday, well, 48 if you count the Thanksgiving holiday. But in terms of trading sessions, literally 24 hours, we were down from above 15 back to 1350, so a 10% drop. Volatility index remaining low. That's also a very, very good sign for the market. Stock market, as I've posted and talked about before, I've written articles about it. Anytime you get that VIX below 17, anytime it's below 20, it's good. But if you get it consistently below 17, that's when the stock market has its biggest gains, especially when the VIX is below 13. So I'm watching that 13 level. We're down to 1350. If we continue to see the historical bullishness unfold, it's very possible we'll see the VIX drop back down below 13. And that would put us into an area where we've seen historically the biggest gains in the market. So it's kind of hard to be bearish looking at all these different signals. The economic reports, I think, even though they were somewhat mixed last week, I think continue to favor a bull market. 10-year Treasury coming down. We know the Fed's cutting short-term rates. So you get all that and you put it together, it's hard to be bearish the market. Anyway, let's take a look at the major indices. So I first wanted to start off with the weekly, how these various indices did on a weekly basis. You can see that oops, sorry about that. There we go. Accidentally hit my keyboard. Apologize. Anyway, as you can see, the transports led the action, gaining 1.45%. The Dow, which again is up near that 45,000 level, trying to hit that level for the first time, is being supported by the Dow Jones Transportation Average, which is also broken out to all-time highs. So, this is the Dow theory. Anybody who follows the Dow theory and thought, well, for a long time, the Dow was going up and the transports weren't confirming. That's not the case anymore. Transports are confirming. So if there was, if you had this kind of as a bearish check mark, it's now bullish as we've gotten that confirmation. So that's a good thing. Small caps also having a good week, rising 1.3%. S&P 500 1.06%. NASDAQ 100 was up only about 0.75% same as the mid caps. And how that looks on the charts, well, got a candle glance chart up here for you. These are weekly candles. So I changed my candle glance look to a weekly so that we can see exactly what happened last week. There's that Dow Jones 1.39%, mid caps only 0.73. These, by the way, are in order of daily RSI. So I've got this in order of descending daily RSIs. So it's just giving you a sense of what's been leading recently. We've got the Dow, mid caps, small caps, then the S&P. Transports, although transports have really picked up in the last 4 weeks or so. I suspect if we continue to sort this by daily RSI, we're going to see the transports probably quickly become part of the upper half of the performance here. And then the NASDAQ, the last one, the lowest daily RSI, even though we're in an uptrend. And I think that's really important to point out that everything here is going up. It's just a matter of what's going up the fastest. And when you get into a market that is, we're playing a little bit of catch up, especially with the small caps, the Dow Jones, the big giant behemoths, those companies are not part of the NASDAQ 100. So money is just rotated and shifted into another couple of different asset classes that have not been leading for a while. As I'll show you a little bit later, I believe small caps are just starting significant outperformance for the next several months, maybe a year, maybe longer. Obviously, we'll keep watching it, but they're doing what we expected that they would do once the Fed funds started cutting, or the Federal Reserve started cutting Fed funds rates. So we've got leadership now from small caps, mid caps, and the Dow Jones, which is awesome. It's nice to see other areas perform. And again, it's not like they're going up at the expense of the NASDAQ 100. The NASDAQ's still going up. It's just struggling on a relative basis, primarily because semiconductors are having a difficult time trying to break out. But remember, I mean, really, it all comes down to perspective. Because if you think about the semiconductors and what they had done, if you go back and look toward the latter part of, it might have been the end of October of 2023, and then where we were on the semiconductor index on June 22nd of 2024, that move that was made on the semiconductors was a 133% increase in 7.5 months. That's unsustainable. It's not a bad thing that semiconductors are not performing well right now. Let's give them a rest, right? I mean, it would be nice, I guess, if you're invested in them, for them to go up every single day at outrageous rates. But at some point, they're going to be so bloated and overbought that you're going to see a massive correction if you don't go through periods like the one we're having right now, where the semis are just kind of going sideways and underperforming. That money that is rotating out of that area and out of some other areas, along with the new money coming into the market, a lot of that is finding its way into the small cap Russell 2000, the mid cap 400, the Dow Jones, and that's why we're seeing that leadership. But it's a good thing. It's not a bad thing. And it's funny how a lot of folks who were clamoring a year ago, or maybe 8 months ago, that we needed more leadership in other areas, that, we couldn't rely simply on the Mag 7, that was a bad thing. It was just the Mag 7. If it weren't for the Mag 7, the market wouldn't be going up. Everybody was bearish, or a lot of folks were bearish on the market because we just weren't getting that wide participation. Breadth readings were horrible. Well, now we've got the flip side. We've got the very strong breadth readings. We've got the Mag 7 stocks that have been struggling. And now folks are concerned because the Mag 7 aren't leading. Can't have it both ways. I love the rotation. I think rotation where you keep everything in an uptrend, I think that's extremely bullish and one of the key characteristics of a secular bull market advance. Anyway, moving on to the sectors. Actually, I think I updated this. Let me give you a quick update here. Yeah, here you go. So here's the summary. And we're looking at the last week again, 1 week performance. Healthcare. Remember I talked about healthcare last week. We saw the XLV get back down to about 140. And it was very close to a key support level at 137. I said, hey, not going to be surprised if we start to see some strength in healthcare. Last week, that was your leader. We saw healthcare perform very well last week. I think the week before it jumped, but we were up 2.25% last week in the XLV. Now we're back to 147 and change. So we're already up about 5% in 2 weeks off of that low down around that 140 level. Real estate doing well. Then you've got consumer discretionary. Look at discretionary above staples. I love to see that because we were going up. So that ratio is going up, the XLY versus the XLP. I like to see that. So we had that in our favor. But some of the other areas you can see, even though they didn't lead, financials have been leading the market. They took a little bit of break last week. XLI, same thing. Technology, which has kind of been struggling overall in the fourth quarter, taking a break, but they're all up. And that's key. They're still moving higher. It's just that not every sector is going to outperform the S&P 500. The only group that moved lower last week, energy. So energy pulled back almost 2%, 1.8%. But that was the only negative or a sore spot in the market last week. Looking at the charts on these, again, these are sorted by, they're in descending order. So highest daily RSIs first, financial still leading, communication services second, discretionary third, which is leading staples, which is fourth, and then industrials. 4 of the 5 aggressive sectors still have the highest RSI reading. Financials, communication services, discretionary, and industrials. Only one lagging is technology, and it's not in a negative, it's not downtrending. It's simply, kind of maybe going along, maybe a little bit of a pattern here. Maybe if we pull back one more time in the XLK, we could have an ascending triangle. You could call this a little bit of a sloppy cup. Maybe we go into a handle and then break out. But this is not a bearish pattern on the XLK. And as I look at all of these charts, I mean, uptrend, 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 up. Well, nice little cup here on the XLE, but off of an uptrend, nice cup forms. That's a continuation, bullish continuation pattern. Uptrend on materials, uptrend in technology. The only one that really short term, and it still held its earlier low, the only one that was maybe starting to weaken a little bit was healthcare. And last 2 weeks, we've seen that big pop in that group. So I just don't see any bearishness really anywhere in the market. I don't understand how anyone's bearish. I mean, the market just keeps going up. Folks were bearish when we got from 3,500 back up to 4,000. They were bearish when we were at 4,500. We got to 4,800, which tested the prior high before we went down to that 3,500 level. We got up there. Folks didn't think we could go through. We got through. Not only we got through 5,000. Now we got through 6,000. 2 years ago. I mean, it's only been 2 years and a month since we hit that low, down just below 3,500 on the S&P 500. Now we're at 6,000. And I've said all along, I did it would have been an article back in June of 2022. You probably look forward to my stock charts blog. But I did one sometime in June that talked about the reason why you wanted to get in June. And I missed the bottom by a couple months. We ended up going back down in October to set a new low in 2022, but not by much. I think we were at 3,620 or something in June. I think the low ultimately ended up being 3,491. So we went down another 3 or 4%. Anyhow, that rally, what I always talk about is the key, the reason you want to try to catch a bottom, because I had a lot of folks back then in June of 2022 say, what's the point of trying to catch a bottom? And so I just responded back then. I was like, are you kidding me? What do you mean? What's the point? The point is you catch the bottom, you're going to make a lot more money because the strongest move in the stock market is off of secular and cyclical bear market bottoms. If you're not in for that first year or even 2 years, you miss the majority of the next move. And now here we are. We're 2 years in. S&P's gone from 3,500 to over 6,000 in 2 years and maybe 2 years, a little over a month. So that's why it's important to try to call bottoms, because you then get the entirety of the subsequent rally back to new highs. Anyhow, but I see nothing but uptrends here, which I think is really bullish. All right. If you go over to EarningsBeats.com, I always like to point this out. Scroll down. You will see an area where you can sign up. If you don't do anything else over at EarningsBeats, come over here and sign up for our EarningsBeats Digest newsletter. It is completely free. No credit card required. You can unsubscribe at any time. We've had tens of thousands of people subscribe to our EarningsBeats Digest newsletter. We try to give back to the community. This is an excellent opportunity, I think, to maybe improve some of your trading results, get used to the way we look at the market. And then once you're comfortable, maybe you already are, maybe you've been watching our videos, but if you're comfortable, now's the time to come in and sign up for the 30-day trial, because we are running our annual fall special. So if you come in, sign up for the 30-day trial, I think we got another couple of days left in the special. So come on in, start your 30-day trial. And if you really like what you see, the various things that we offer in our service, you can sign up right now and save a lot of money on an annual membership. And by the way, annual membership saves probably 40% or more off of a monthly membership. So you really, 90% of our members are annual members. So you really want to take advantage of the savings there, plus the additional savings of our fall special. So now's a great time to come in. Anyhow, if you are on your mobile device, there should be a slide up now where you can simply scan the QR code and it'll take you to a landing page on your mobile device where you can also sign up for our free newsletter or start your 30-day trial to our paid service. We'd love to have you. And by the way, at the end of your 30-day trial, right before it ends, we're going to reach out to you and remind you that your 30-day trial is expiring. We don't want you to stay on. I know sometimes you don't want to do a no-cost trial like this and then automatically be charged. You forget about it, that kind of thing. Trust me, we'll take care of that. We don't want you to be a member if the service isn't for you. But I can tell you that we got a lot of happy members in our camp right now. Anyhow, going back to the EB Digest, I'm going to just wrap up with this. I'm going to show you the last 4 charts that I have provided in our EB Digest. So just so you can see some of the value. And again, it's a zero cost. So if you get any value out of it, hopefully you get some education, if nothing else. But I think these last 4 charts have been pretty amazing. Anyhow, here we had a move up. This was out on November 20th. So it was right here just before we had this final test of the 20-day moving average. I had drawn a line up here and said, this is the target. Here was the support off the 20-day moving average. Here's your target. 3 days later, we hit the target. It was a quick 10% profit on this trade. And then look what happened. We went up to resistance and pulled back. Now, I think we've got to move up, a cup and a handle. I think it's going to go up and break out. But that was just a quick 3-day move up 10%. RH, this is another one I gave out in the video a couple weeks ago. Featured this one. I believe it was on at the beginning of, or maybe, I don't remember when I posted it, whether it already made an advance. and I was just kind of pointing out what we had done. But anyway, back here, you see this red candle back on November 15th? That close at 3:15 was the date of a video that we sent out to anyone who wanted to start a trial service with us. We gave a little bonus, said we're going to send you a video, going to show you a chart of why I'm so bullish on small caps. And I'm also going to give you 10 small and mid cap stocks that I really like. This was one of the 10. And it's gone from 315, it almost hit 400 in a little over a week. And we've had several of these small cap and mid cap stocks that we put on that list that have done extremely well since we sent that out. The third one I put out there was SMCI. So SMCI was the darling that went crazy, got up to 1,200 and then had a 10 for 1 split back to 120 and then went down, had the accounting firm fiasco where the accounting firm said they were leaving, went down, and then started working its way back. Had a lot of members asking about it. Is now the time to get in? I think probably we want to let things settle for a little bit. But what I showed was a chart connecting these two bottoms, coming across, beautiful horizontal line. And what we saw is this recovery back up here was about to the area of this prior support, which is now resistance. And then this last move up went right up to that level, right around 39, couldn't get through, and back down to 39.3, or excuse me, 33, probably 33 or 32.64. So it was probably about a 15% drop, maybe even a little bit more than that. But we went right up to that resistance, and I drew that line across and said, we need to get through this area. And we didn't do it. We turned around, came right back down. And then the last one I just gave, this is a weekly chart, but what I was showing was, look at the way WHD has traded over the course of if you go back to 2020 and 2021 into early 2022, back when small caps were in favor, look at what WHD did. Went from about $6 to 60 or 70, like a 10 bagger. And from there, while we haven't done well in the small and mid caps, WHD kind of did, I don't know if you want to look at this as kind of an inverse head and shoulder or maybe just a cup with a handle. Whatever you call it, it's broken out. Volume trends have turned much more bullish over the last 5 months since money started rotating into small caps. I said I think this is a stock that could triple. If I'm right about the small caps leading over the next year, I think this stock could be $200, 68. We'll see what happens. But anyway, those are the types of things that we've been putting out in our Earnings Beats Digest. So we would love to have you come over, check it out, subscribe, join the tens of thousands of folks that are with us now. We'd love to have you join us as well. So that was basically it for me for today. Just wanted to kind of show you how bullish the market was last week. It's very typical for Thanksgiving week. And also the week following Thanksgiving tends to be extremely bullish as well. So I'm thinking more of the same as we go into next week. I don't know if that gets us on over 45,000. We're not that far away, but we certainly could see the first close above 45,000 on the Dow. Now that we've gotten through 6,000 on the S&P 500, I think we've got loads of room there. And the IWM, which got through that 234 area for the first time in history when we got through up into the 240s. We went right back down, went a little bit below that level, actually got back down into the mid 220s, and now we've come roaring right back up, and the IWM sitting on the verge of new highs again. So everything I think looks really bullish. Kind of hard for me to be bearish the market at this point. So I'm just kind of in that status quo mode. I think the market goes higher. I'm going to remain long, and I'm really looking closely at a lot of small caps and mid caps. So come on over to Earnings Beats and join us. We'd love to have you. Please click on the like and subscribe to our channel. That would certainly help us in our efforts to try and build our YouTube community. So if you like the video, certainly help us out with a like there and subscribing to the channel. Anyhow, have a great week or rest of your weekend, everybody. And to be back next weekend to do it all over again. Happy trading.